I'm Evelyn Risley for DealBook of the New York Times. Joining us today is Luke Kerner. He's an analyst with Wedbush Securities. Thanks so much for joining us. As we reported, Groupon is apparently hurtling towards an IPO later this year. They've been talking to bankers, and on top of that, according to the people we've talked to, the valuation for this offering could be as high as $15 billion, maybe even more. So $15 billion, that's a lot more than Groupon has ever been valued. What do you think about that? What do the numbers say?
Well, what we know is that Groupon shares are traded in the private market now at valuations in excess of $5 billion. And we generally believe that when companies are public, they trade at a significant valuation above where they're trading at in the private markets because of liquidity, transparency, and other things that investors pay for.
At that $15 billion valuation, though, that's roughly triple where we've been seeing it trading. So do you think that with revenues of roughly $1 billion or so per year, that justifies that kind of multiple?
Investors who are going to be buying the shares when they go public aren't buying Groupon for the revenue that they have in 2011 or 2012. They're really looking out a few more years because this is a company on a very, very steep growth curve. And so what they're really buying on is what they think the company's going to do in 2014 or 2015. And based on Groupon's growth over the last year, we think that investors, there'll be a lot of appetite for investors for Groupon shares.
Where a company is growing, though, in its first 2 or 3 years could be very different than 5, 6 years down the road, right? So the question is, can Groupon maintain that kind of momentum? There's a lot of rivals. Living Social is number 2. It's nipping at its heels. Do you think that they can create a defensible business model to really justify that valuation?
Well, you've got a brand new e-commerce sector now. Only a couple years old. Groupon, really helped start this whole e-commerce sector. And what we know is that it's embryonic and it's going to evolve rapidly. And Groupon has to run really fast, has to evolve rapidly to continue to maintain a lead.
Let's talk about the timing of all this. So Groupon, they recently rejected a $6 billion or so bid from Google, and that was in December. So now we're looking at them putting together an IPO for maybe even the springtime of this year. Are they trying to rush because there's a sense that the IPO window is open?
Well, what they know is that there's a lot of investor appetite today for the shares. So a lot of companies want to strike, when the iron's hot, and the iron is certainly hot for Groupon today.
Mm-hmm. But in terms of other companies, we've seen LinkedIn, possibly going to IPO this year as well, and then in 2012, everyone is looking forward to that Facebook IPO. So it seems like now is a time for tech companies to maybe start testing the waters here, right?
Well, what we think is that social media as a sector is very much like the internet sector was in maybe 1996, 1997. A lot of companies were just started to come public then, and there was a lot of talk about the internet bubble, and what we saw was that valuations continued to climb dramatically for the next several years. So we think, again, we're in that kind of early phase of social media. There are some early leaders or there's some public companies in social media today like I.P.O, who's growing very rapidly, and there are companies that have more traditional internet businesses that have now extended into social media, have extended into group buying, like Travelzoo, that we've seen rise dramatically in value. So we think we're going to see a lot of companies coming public in the next couple of years.
It's always really troubling when you start drawing parallels to 1996 and 1997 because we know what happened soon after. Do you think there's some frothiness in the market? Do you think that this is actually more of a case of real businesses with real revenues? I mean, what is your sense?
Well, what happened in 1999, as we all know, is you had a lot of companies coming public that really didn't have business models. The companies that we're here discussing now, Groupon, Facebook, have really tremendous business models, are scaling rapidly, are profitable, and so I don't think the comparisons between 1999 and what's going on today is really relevant. And in fact, I think it's not 1999 in our view, it's more like 1996, 1997 with the start of this whole new thing called the internet, and today this whole new thing is called social media.
Well, thank you so much. Once again, our guest today has been Luke Kerner. He's an analyst with Wedbush Securities. I'm Evelyn Risley for DealBook of the New York Times.